Okay, so now we will look at the fair value adjustments. Hello, are you there?
Yes, I'm here.
Yeah. So we'll look at the fair value adjustments guided by IFRS 3, which is the business combinations. This is one standard that guides on how we should compute goodwill. So in this case, we are actually looking at fair value adjustments. How do we adjust fair value? So for example, you have fair value of identifiable assets and liabilities on a line-by-line basis into the group of statement of financial position or the balance sheet. This fair value, it could be the property, plant, and equipment. It could be inventory. It could be contingent liabilities. So how do we adjust it? So the first thing that we have to do, we have to adjust the subsidiaries' net assets, which obviously we'll see in the example. So that working two, we'll have to adjust it. And this is what we did on inventory. You remember we did this fair value adjustments.
Yes, yes.
It's the same thing that we are actually looking at. So you go to working two, you make sure that in working two, you adjust. If it is the inventory that has to be adjusted, you are actually going to give fair value adjustments, meaning that that inventory has to be adjusted. If it is property, plant, and equipment, so be it. If it's contingent liabilities, you have to do it. Because for you to get the net assets in the subsidiary, since we only look at the equity part, it is as good as saying assets less liabilities. Assets less liabilities, it actually gives you your equity. You get it? So this is why you should not get confused when you're actually looking at, when you're making adjustments in the net assets in the subsidiary, which is working to, where you have to make adjustments if it is coming from inventory, you have to make adjustments if it's coming from buildings, you have to make adjustments if it's coming from equipment, you indeed have to make adjustments if it's coming from contingent liabilities. But never forget, as long as there's some element of depreciation, if it is a depreciable asset, if in that working two, in the net assets, you should also adjust depreciation. Hello?
Sure.
I hope the same one is okay.
Oh, it's okay. It's okay.
Yeah. So let's look at this illustration. A parent company acquires a subsidiary at the start of the reporting period, where the fair value of the property, plant, and equipment is 50,000, quite higher than its book value. And the remaining life of the property, plant, and equipment is 10 years. So the first thing here that we'll have to do, we need to, when we go in working two, we know that there's a fair value that we are going to bring in, which wasn't actually taken care of at report date. So the property, plant, and equipment, meaning that it increased by 50,000. Yes. So you are going to have that 50,000. But remember that you have to adjust it at report date. You have to remove depreciation in there, because it says where the fair value of the property, plant, equipment. First, let me say a parent company acquires a subsidiary at the start of the reporting period where the fair value of the property, plant, equipment is 50,000 higher than its book value. Already, if they say it's higher than the book value, all you see in the balance sheet is at book value, meaning that they have already computed them. Anything that you see in the balance sheet is part of the book value. So what is not in the balance sheet is going to be stated by the examiner. In this case, we have been told that the fair value is 50,000 higher than what is in the book value. So what does it mean? When we go to the net assets in the subsidiary that working two, we'll have to plug in fair value. Maybe we show PPE 50,000. But we are not going to stop there. We have been told that this book value the remaining life of this particular asset that we have made adjustments to, its lifespan is 10 years. So we know that at report date, if we put the 50,000, we'll actually do a lot of injustice to ourselves, because we'd have assumed that it wasn't a depreciable asset, like as if it was just land. So then we'll have to find the depreciation for that particular period, which will be 50 divided by 10. It's going to give us 5. Meaning in the net assets in the subsidiary, we'll have the fair value of 50, then we'll have depreciation less 5. So that it takes us to 45 plus other elements that are already there, like the share capital, retained earnings, and many other things that you can find under equity. So, having said that, this is how it's going to be done. Fair value, which is PPE, like we said, like I explained, we are going to have a 50. So that in a way, we are adjusting what is in the book value because it is not correct. But we know that this 50 PPE, it also comes with its depreciation. As long as we are using these assets, we will need to depreciate them. So that extra depreciation of 5 is actually going to be deducted from 50. And the way you got it, obviously, was your 50 divided by 10 years and gave you 5 as depreciation. So once you do that adjustment, you also need to make an adjustment under property, plant, and equipment on top, the first half of the balance sheet. Like I've already said, that the balance sheet is in 2 halves. The first half is the eyes. It's what you can see. The assets are basically, it's your eyes. I'm able to see a vehicle, I'm able to see a building, I'm able to see all these things. But the question is, how are they funded? That is where even rumor mongering comes from. It's basically now your ears. You hear that those assets that you are seeing, the houses that this guy has, they were funded by a loan, or he used his own money to fund these assets. So equity and liabilities, they are your ears. That's where Mlomo comes from. That is where rumor mongering comes from. Whereas assets are your eyes because you are able to see them. So meaning that on the first half of the balance sheet as well, because remember that this fair value, which the extra fair value that you are going that you have used to adjust your net assets in the subsidiary, wasn't included at the report date in the financials. So meaning that on the assets part, property, plant, and equipment, you're going to add the 50, then less depreciation of 5. If you don't do that, it is not going to balance.
So 45 as part of assets.
Yes, you get it. You get it now, right?
Yes.
So this is how it's going to be on the first part of the balance sheet, proper plant and equipment. You are actually going to add what is coming from the P, from the parent company at 100, what is coming from the subsidiary at 100, plus that fair value adjustment, less depreciation. That is what you're going to have. Is it okay up to here?
Very much.
Mm-hmm. Similar principle on contingent, but then maybe